Hello, you're watching Dukascopy TV. I'm Ben Jones, bringing you this first commodities corner of the week. West Texas Intermediate's discount to Brent crude oil reached its widest in 8 months yesterday after further speculation on Fed tapering. Joining me on the line to discuss these commodities is David Bouckhout from TD Securities. Now, to begin with, David, we have seen figures for Brent crude oil waver recently. What are the causes of this volatility, and how do you see this commodity faring in the future?
So, in our view, the Brent market, which is considered the global oil benchmark by many, has chopped around between $103 and $112 per barrel since around mid-September. While we don't anticipate it breaking outside this range and over the near term, our bias is tilted in favor of the downside. Near-term supportive factors such as geopolitical risks that have constrained some output out of Libya and Iraq, for example, are being offset by positive talks between the West and Iran that could eventually see some sanctions eased that have obviously hindered the output from Iran. And also, there's the view that global oil the balance of oil is still quite loose in the sense that global oil supply is more than ample to meet global demands. So from that perspective, you do have some downside pressure on the Brent crude price. However, we don't expect the market to tank, or we're not expecting a huge rout. There is a strong protection particularly on the Brent crude price from those oil-producing countries that rely heavily on oil revenues.
Now, looking at WTI, the commodity has recently reached a 5-month low. So what do you see as the most significant events over the next few months that will change the market, and why?
So WTI is a little bit of an interesting one because it may have a lot of that global influence that Brent has. However, it still has a lot of regional influences, which we have seen in play quite a lot recently, and in the last couple of years anyway. So from that perspective, we do see WTI being affected by its sharp increase in domestic supply in the United States. So, this summer we saw WTI prices rise quite sharply as Cushing, Oklahoma, which is the delivery point for the financial contract for WTI. What we've seen the inventories at Cushing, Oklahoma come down considerably. Now that has given a little bit of a lift to the market. Now in the last couple months, though, we've seen those inventories build again. Some of this is on the back of seasonal factors. For example, you have refineries in the area that have been down for maintenance. Now this is a seasonal maintenance thing. So as refineries go down, obviously crude oil is not as in high demand. So we see stockpiles building up. Now we see this happening, continuing for the next over the short term. However, we don't expect this to be the end-all be-all. We think that we're going to start to see those inventories come off again as we head into the new year and into Q1. And from that perspective, we do see the potential for some support for the market. So we're not expecting, again, a big rout similar to Brent. We're not expecting a big substantial move lower.
And finally, it's estimated by the International Energy Agency that the US will become the world's top oil producer by 2015. Why is this, and how will this affect the market?
So, as mentioned in the previous question with WTI and the sharp increase in domestic supply for the United States, that's really prompted many forecasters to change their tone. We were expecting growth in the U.S. from supply from a lot of these new tight oil plays, for example, the Bakken or the Eagle Ford, but they have their output increase has surprised the market. We weren't expecting to see such growth so quickly. So from that standpoint, many of these forecasters, like the IEA, have boosted their outlook on supply growth, and they're now expecting the IEA is now expecting the U.S. to surpass both Russia and Saudi Arabia as the world's top oil producers. Now, from our perspective, while that's certainly possible, if you include natural gas liquids and condensates, which the IEA is, then that is certainly possible. However, if you exclude those and you just have oil on its own, we're not quite as confident that the U.S. would surpass both Russia and Saudi Arabia in the next 2 years. Now, that aside, we are expecting a sharp increase in U.S. oil production, and this will affect the market in the sense that we're likely to see the U.S. continue to displace foreign imports, primarily those from outside of North America sources. So, like Venezuela, for example, could see a reduction, although they have mostly heavy oil, and most of the oil that we're seeing produced in the U.S., and the production growth anyway, is coming from light oil. But this could also affect those imports from maybe North Sea, those from Africa, both West Africa and North Africa, as well as the Middle East.
David, thank you for joining me today. That is all for this edition of Commodities Corner. Make sure to stay tuned to Dukascopy TV throughout the week for more updates and exclusive interviews. Goodbye.